there's kind of like this fear for a lot of people, even if we can find a better value situation, even if we're giving them better advice, there's a nervousness to leave what they know right now because of what they don't know is in the marketplace. And I think that's costing people, no, I know that's costing people a lot of money because if you're... Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadden, and I'm your host. I can't wait to get you into the flow. Well, after what feels like an onslaught from the federal government for the better part of the last few months of data, of information, of rules, we finally had what appears to be a little bit of a slowdown or a settling down in terms of rule changes and tax guidelines and all that kind of fun stuff. We know what's coming from the budget. We know when it's coming as per the capital gains taxes. We also know what to expect for first-time buyers. So I don't know about those out there who are in the marketplace or watching the marketplace right now, but I'm starting to sense a little bit of a shift or a change in the overall performance of the marketplace, but just general sentiment among potential home buyers and investors right now. Well, in today's chat, today's conversation, today's podcast, we're going to talk about CMHC's mortgage consumer trends for 2024. And there's some really interesting stats in here. And whether you're a realtor in the mortgage industry or just general consumer, I think a lot of these things will probably surprise you. And I'm going to add some commentary to a lot of these points to provide some context to make sure that it all makes sense as to what this means for you and what it means for the general consumer. These types of studies are super important for anyone in or out of the industry to really understand what the general sentiment of the consumer base of people is. Like, what are people thinking right now? What are the things that they're planning to do? How are people taking action? So again, whether you're an investor or somebody upsizing or somebody just genuinely curious as to what other Canadians are thinking right now, then this data is going to be powerful and important to you. Before we get into it, I want to talk a little bit about general sentiment and something that's come up a lot in the better part of the last few weeks. And I wouldn't say that this is something new per se. It's just something that I've seen more of and more of and more of. And that's this mindset among people of I'll never be able to do X, or I won't be able to buy X, or there's no chance that I can get into the marketplace in X city. And just in the past few weeks, I've heard, I don't know what the word is extreme, but I've had a crazy amount of people actually tell me that they believe that they'll never be able to own a home in their city or move up or own detached. And so they're going to resort to either A, buying a condo that's a 1 bed or 2 bed and living there for the next 20 years, or rent and just continue to do so because they just feel like it's impossible to buy in the city or something of that nature. And I find that what that's leading to is it's just genuinely speaking, leading to a lot of false truths. So a lot of things that people are suggesting, which are rumors, a lot of negativity, which is not unusual around the housing market, let's be honest. And then just, it's sad from my perspective that people are going around and saying to other people like, hey, you won't be able to do this. You won't be able to buy a home. You won't be able to buy a second investment property. There's no chance that you're going to own anything greater than a 2 bedroom property. Most of this stuff really comes down at the end of the day to misinformation, media, where they're getting your information and where it's coming from, and the types of people that you hang around. So I think my biggest feedback would be for those people out there who have their minds wrapped around this thing: I can't own a second property, or I can't make a move into my city, or I can't do one of these things. The truth of the matter is really at the end of the day, it comes down to a mindset, which is a mindset of change. What do I need to do to be able to make this happen? And two, a plan and a strategy. So again, this could be different depending on whether you're in the industry or out of the industry, but I really wanted to start off by having that conversation really quickly because I think it's important, imperative. The point of my podcast is really to educate and inform and to help people create better financial decisions. And I see a lot of bad financial decisions or poor financial decisions being made every single day. However, they're typically related to people's mindsets around the decisions they make. They don't start because they don't think they can, or they heard information. So where are you getting the information? Who are you talking to? What is your plan? Is it even realistic? I mean, the truth of the matter is, yeah, if you're looking to buy your first home and you make $65,000 and you want to buy a condo in downtown Vancouver, that could be a challenging play, but there are ways that you could make it happen, or you could buy something outside the city and you could work your way up to that type of property. The reality is if you don't get started, you're never going to get there. And so Big message. Want to say that to a lot of people there because I've heard it all across the country, and I think it's just a lot of negativity and it needs to get out. You need to obviously work hard to get where you need to go. And the truth of the matter is, if you don't start, you're never going to get there. So let's get into CMHC's mortgage consumer trends. There are some surprising facts and findings within these trends. And as I mentioned, I'm going to add some color to them. Also, towards the end of the podcast, you're not going to want to leave early because I'm going to talk a little bit about what to expect for future projections when it comes to rate cuts as per the last couple of weeks. So depending on when you're listening to this, this could be really relevant to you. And in addition to that, what are people doing with their mortgages right now as well? Like, what are some things that people are considering? So let's get right into it. So the top 10 insights or highlights from the CMHC study. I'm going to rattle off some of the key points that the study found, and then we're going to dig into it. Number one, unsurprisingly, people are choosing longer amortization periods. We're going to talk about the 30-year amortization versus 25-year amortization and what this actually means for you. But that is number one. Number two, more people than ever are researching mortgage rates online. And interestingly enough, and to benefits of people like me who are out there, they're gathering their information directly from sources like Instagram and TikTok and YouTube and sources like that to gather more information and being informed in their decision. In fact, there are more people than ever who are actually finding their brokers and advisors online, which I'm also personally noticing because I'm getting more of you guys reaching out to me to ask me questions. I'm inviting that. It's just so nice to be able to actually talk to and communicate with people. This survey showed that people are actually purchasing less homes right now compared to in the past. And that's not surprising given where interest rates are at right now. They're using the same lender more often. We'll touch about why that could be the case. They're less confident they're getting the best deal, which is interesting. Like, people are using the same lender than ever before, and they're less confident about their goals. I think a lot of that has to do with confusion around options. They're relying more than ever on gifts for down payment. That's something we've heard a lot about, and we've seen some of that. And they're more worried than ever about overpaying. So in the past, this wasn't as big of a concern. People would pay a certain amount from the home and they would think they would get value back. Well, now people are worried about overpaying and then not getting their value back. So they're not really seeing that appreciation in the properties. In addition to that, more concerned about their debt level than ever before. Not surprising given the current debt levels of the Canadian consumer and where things are at right now. And they're increasingly scared, actually scared or terrified about rate increases. That is something that is haunting people right now. So let's just talk through some of these insights from this particular study and get into the specifics of what it might have meant for you. I do want to suggest that right off the bat that these are just survey results. This isn't necessarily what I've seen per se, so definitely want to talk to that. So based on the study, the first and most interesting thing is it took buyers on average 4.2 years to save for a down payment. Think about that. 4.2 years to save for down payment. Now, if you're getting started right now today, that could seem like an extraordinarily long period of time, but the truth of the matter is it actually isn't that long. If you think about purchasing a $500,000 condo, for example, or townhome, depending on which community, or even house, depending on which city you're living in, from Vancouver to, Edmonton, Alberta, you're looking at a situation where if it takes 4 years, that's not much. That's like you saving $5,000 to $7,000 a year of actual cash. So we'll call that $7,000 a year, depending on obviously the 25,000 plus closing costs and so forth, assuming you don't get any RRSP matching programs. I thought that number was actually kind of low. I was expecting that to be a little bit higher, but I assume that could have something to do with gifts. Maybe it has something to do with general appreciation in the marketplace. But with that being said, I did want to point out that I have noticed, historically speaking, people will wait a long time to buy because they need to save, or they think they need to save to 20% down payment. Whereas the truth of the matter is that if people purchased when they could qualify for what they qualified for, they'd make a lot more money in appreciation over 4.5 years compared to actually continuing to save money. As an example, as illustrated by my friend Mr. McLister, he suggested that if you wait 4.2 years from today and a home appreciates at the long-term rate of 5.75% per annum, you'd pay over 26% more for your home in 4.2 years. So for people who are waiting 4.5 years or 4.2 years to save up the money for a down payment for a property, they're actually going to have to continue saving as time goes on if they're not actually investing that money and getting a greater return on their money than 5.75% per annum. Unsurprisingly, most people I don't think really have a plan for that. And I think that's one of the biggest failings. So if you're a parent and you're thinking about this for your kids and you're like, where are my kids going to be able to purchase? So let's project out, let's say they need to get that $500,000. They start when they're 12 years old. You want them to be able to buy a home when they're 20 years old. That's 8 years. If they started when they were 12 years old, not including any compounding interest, which we would hope that they would gain from investing or putting their money into something from that perspective, these kids would only have to basically save $60 a week for the 8 years to be able to purchase a home. $60 a week. Now, as a 12-year-old, that might seem like a lot. So maybe as a 12-year-old, they start with $10 a week or $20 a week. But when they become 15 or 16, what's to say that they couldn't move that number up to $100 per week at that time? And then, of course, to save or invest that money could easily put them in a position to be able to purchase a property. And so I saw that as a unique opportunity for people to look at this from a perspective. A, don't wait to save too much money, get into the market sooner and let the property appreciation make money for you. And number two, B, look at this from a parent's perspective. If you have kids, start teaching them about the ability to compound their payments and set their money aside as quick as they can. All right, number two, interesting stat. We saw more mortgage shoppers than ever before shopping for mortgages exclusively online, 52% versus 34%. And the truth of the matter is, all that basically means that people are contacting people digitally through Google, phone calls, text, email, social media, all these types of things, as opposed to physically going to the banks first. Mostly people were just frequenting rate sites. According to the study, they weren't really understanding or specifically looking for what they were actually trying to gather. But the truth is, more people now are actually looking for this information online to do research. Interestingly enough, people are still looking to work with humans or people versus just actually working through a direct rate site. But with that being said, that was a massive increase from the years before. Another statistic, only 1 in 5 mortgages last year were purchases compared to the previous year, which is 1 in 4. That's a big change. And I wasn't really shocked to see that one, just given the fact that the interest rate increases occurred during 22, 23, and then into 2024. I would suggest we're probably going to get back into a normalized market in the next 12 to 18 months, given where things are at. We've also seen more people than ever look to stay where they are because of the high costs, look to consolidate debt, refinance, restructure, do a refinance to add in value to their existing properties. And there's just general fear in the marketplace. The moment that the BOC starts to cut rates and the adjustable rates start to come down, best believe you'll start to see people moving and purchasing. And I think we're already starting to see that moving forward. Interesting stat, again, almost 1 in 10 buyers said they wouldn't have been able to buy without a gift. Now, this is interesting because those were the people that were surveyed who had a gift for a down payment. So out of those people who got a gift for a down payment, 9 out of 10 of them basically said that they would have to have that gift to be able to purchase. So with that being said, what would that look like for the people who didn't get a gift? Would they have been able to, if they got a gift, purchase, or the people who couldn't purchase, would a gift have made sense? Hard to say exactly, but that's interesting. This leads me to think about the understanding of something that I've focused on pretty heavily in the last 2 years, which is joint ownership, co-ownership, unique agreements for people to be able to purchase real estate with mother, father, uncle, brother, sister, friend, these types of things. We've seen a lot of that in the last couple of years, and they're not just black and white. There's definitely a lot of things that you need to be aware of, especially when it comes to these agreements in place. So what about those types of opportunities for those who can't get a gift? And where are they looking? Are they actually looking for them? Which brings us back to that whole thoughts of mindset and getting into the marketplace. There are ways to do it. There's probably somebody else out there who wants to be able to benefit from either investing with you or, alternatively speaking, help you out. Are you talking to those people? Are you asking people? Another statistic, 3 in 10 buyers use the equity from their previous home as part of their down payment. This is not surprising given the fact that more and more people are understanding about the ability to utilize equity from their existing properties to buy second homes, investment properties, vacation homes, but also B, people understand about the ability to be able to leverage their property to move up. Now, with property values having bottomed out or come down in many markets, we saw less of that in the last year compared to previous years where people were leveraging up like crazy. From 2019 through 2022, that was a big play. As people would buy, their equity would go up, then they would have more leverage to be able to purchase another home. That's not necessarily the case in this last year. Another statistic that stood out here is that 53% of buyers worry about rate increases now, as opposed to 37% before the pandemic in 2020. That's a wild number. Now, what that is leading to is a few things. That point that I had mentioned earlier about people renewing and staying with their existing mortgage companies or banks, a big part of that is that the existing companies are pushing pressure on those points and saying, hey, Rates might go up. You should lock in today, or you should look at taking this mortgage product right now. Stay with us. You don't know what's on the other side. And I think we're going to see more and more and more companies push hard in regards to retention, and people will probably end up spending more money or paying more money due to the fact that ultimately there's a fear in the marketplace of rates going up. At least until rates start going down, there's a lot of anxiety and stress from people when it comes to these types of things. 72% of repeat mortgagers are using the same lender versus 63% before. So that says to me again, same thing. People are afraid. They don't want to explore what's out there. So even though people are researching what's in the marketplace, they don't feel confident about getting the best deal, and they're staying where they are, which is really interesting. And I've kind of noticed that myself. There's kind of like this fear for a lot of people, even if we can find a better value situation, even if we're giving them better advice, there's a nervousness to leave what they know right now because of what they don't know is in the marketplace. And I think that's costing people. No, I know that's costing people a lot of money, because if you're only going to stay where you are because of what you knew, chances are that existing lender, existing situation is not serving you to your best situation here. 68% of mortgagers, that's borrowers, believe that they snagged the best deal now that they could have versus 77% pre-pandemic. That's a really interesting stat for me, because one of the things that I believe, because I see it every single day more now than ever, is that confusion and misinformation creates chaos, which basically means that even if someone, generally speaking, did get a great deal, a great option, or a great term, or any of these types of things available, they might not feel that way because they might not see that online, or they can't physically compare that to existing terms. Now, we're working very hard to create more tools to visualize strategies to people to show them how their situation is unique and how that's going to benefit their personal circumstance more than ever. Because it's kind of like going out and saying, okay, well, I went to this car dealership and I'm looking at Corvettes, but I'm looking online and I see the cheapest car is 35 grand. But behind the scenes, that 35 grand is a Honda Civic. You're looking for a Corvette, which is going to cost you 100 grand. But if you pay 100 grand, then your friend doesn't actually show you what your car is. Long story short, you feel bad because you feel like you paid more. And I think most people have that problem right now, not knowing the difference between the different options. And we're kind of seeing that as a portion of what people are saying right now. Ultimately speaking, the objective goal is to create greater transparency and education, to create different options for people to understand. And I think at the end of the day, to provide annual analysis to make sure people feel like they're in the best situation, which is objectively our goal to do on a regular basis. In fact, as a little bit of a tangent, we're working together with a software company to develop a software that allows people to monitor their mortgages to make sure that they're getting the best value, and that they could refinance or restructure where it makes sense, so that they can look at different options when the time comes. On and on and on. There's quite a few other key points here, but the key takeaways for me in listening to this survey is there's obviously a lot of fear, as we talked about before in the beginning, of rate increases. Now, that could be subsiding due to the fact that there's a lot of positivity in the marketplace about the potential of the BOC to start dropping interest rates. But I truly believe, and I believe this because I talk to people every single day, a lack of information and education is really causing people to feel a lot more stressed out than they really need to be. And the fact that most people don't simply have a plan. You see, people spend more time researching a vacation than actually having a clear discussion and analysis of why they're picking a mortgage product. Unfortunately, the same thing occurs, and that's why I use the car analogy all the time, where people will spend more time going back and forth trying to figure out and debate the 5,000 different, features of a car, but they won't actually try to understand why it would make more sense to pick X product lender versus X lender, and they just simply look at the price point. So most people are just missing out on that strategy component, which is costing them thousands of dollars. Speaking of which, one tangent or point that I wanted to make here that I think people will find interesting is this conversation about amortization periods. Ultimately, when people ask me, should I go 25 or should I go 30? And in many situations, people don't ask me. They just say, oh, I just assume I could go 25. So if you have at least 20% equity in your home, you can do at least 30-year amortization, except for those apparently who will be buying new builds with a first-time homebuyer program that's coming up. But notwithstanding, anybody who takes a 30-year amortization, if you read a lot of the articles out there, it sounds like these are the worst things on earth. But I think I want to point out a few things. First of all, I take a 30-year amortization in all my mortgages, but I want to offer some information for anyone wondering why you would want to do that. Why would you want to take a 30-year amortization and pay your mortgage over a longer time frame and pay more interest? Well, it starts off with the benefit of qualification. Easily, right away, if you take a 30-year amortization, you can qualify for more money than a 25-year amortization because we can stretch out the monthly payment, therefore reducing it, which allows us to reduce your debt to income ratio. After you get your mortgage in place, you can ultimately choose to do prepayments by adding a lump sum to your mortgage anytime, depending on the lender, which is why the lender is so key in that situation because they're all different. Or you can just increase your monthly payments. But the key is to get qualified for a mortgage, we must choose that 30-year amortization to be able to get you into the home. The second one is giving you the ability to take that 30-year amortization if you're someone who's investing into real estate or wants to utilize your debt for other resources. If you have the lowest payment reported on paper, it gives you the ability to qualify for more when it comes to that second home or third home that you're looking at doing. Another key consideration of why we suggest people to keep their payments low and use the lump sums. If you're an investor and you understand how to invest your money to make more money than the amount that you're spending in interest, well, you could utilize the lower monthly payment, invest that cash and apply it, and even consider putting this together with something like the Smith maneuver, which allows you to write off the interest on your mortgage. Again, same thing, looking at a 30-year amortization helps you to achieve these goals, and on and on and on and on. And so for anyone who's considering amortization period, should I do 25, should I do 30? Sometimes it's going to be chosen for you. You have to do 30 to qualify. Or because you're putting 5% down, you're buying a resale property, you've got to do 25 years. But I do think that most people need to put a real detailed analysis into understanding the specifics of what they're doing and why they're choosing it. Some other little interesting tidbits right now for what's going on in the marketplace. BMO recently had a survey, and they suggested that we are coming into a peak rent growth and that we're going to see the amount of increases in rental values go down. Now, I don't want you to disguise that or excuse that or mistake that, I should say, with the fact that rental rates are coming down. It's just that they've been going up at such an extreme number for the better part of the last couple of years that we are anticipating from BMO is anticipating that instead of seeing these massive increases, we're going to start to see them go up at a lower pace than we did before. Although from my perspective, I think that's kind of hard to see given the fact that we're not really seeing a lot more rental stock in the marketplace, and I'm seeing a significant amount of people sell off rental stock. So I'll be curious to see if that actually comes to fruition. So if you listen to the end of this episode and you're kind of wondering, what does this CMHC stuff mean all for me? It just means that this is the general sentiment of consumers and what they're thinking. And my goal and my hope for you is that you take this information and utilize this to your benefit and whatever that means. If you would like to work with me and my team, we're here to help you. Just send us a DM on Instagram at Flow Mortgage Co. or at The Mortgage Pug, or you can find us on our website at getflowmortgage.ca. We love a review. If you found this information helpful, useful, give us a rating, like, thumbs up, share it out with somebody else so we can help another family. See you next time. That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.